Now, the EU has revealed that Greece's budget gap last year was worse than feared. It prompted Moody's to downgrade its rating of Greek government debt, as I mentioned, and this news triggered a slide in asset prices of Greece and also increased pressure on Athens to seek loans from the EU and the International Monetary Fund. Let's speak more about this with Simon Mariner, who joins us right now from St George. Just, Simon, before I ask you a bit more details about this, do you think this is maybe what's weighing on the market? Because I know we were expecting kind of a moderate session, and at the moment I'm looking at about a 0.6% drop.
Yeah, certainly. I'm sure we'll talk about some mixed messages we're getting out of Europe. US had a fairly steady night. You know, if you look at their data, they had existing home sales better than expected, rose for the first time in 4 months. You know, certainly just the beginning of things there, but being helped along by tax credits from the government and also the warmer weather. I think housing outlook for the US will be driven in the second half by you know, hiring and employment, and we also saw some good numbers there. Initial jobless claims moving in the right direction for the first few weeks. So certainly things you know, boiling away quite nicely there in the US, but yeah, some bad news, mixed message out of Europe overnight.
Simon, so with the jobless claims numbers, it seems that maybe there looks like there's some sort of improvement. But just when we're hearing from these big companies with the earnings season, I don't think we're hearing so much of companies, you know, adding jobs, coming out to say this is the profits, this is the outlook, and by the way, adding more jobs, because obviously this is the issue which continues to hold back the economy.
Yeah, certainly. Look, the conversation is yet to swing, as you correctly put, to job creation. We're still talking about, you know, arresting the decline in jobs. You know, initial jobless claims moving in the right direction is an indication of that. We will also get, or the initial jobless claims number will go into the next number we see in terms of private sector employment. That was about 123,000 last month. But if you remember, we mentioned that, you know, population growth alone means that they've got to put 100,000 jobs on each month just to keep up to pace with that. So be interesting to see you know, what goes on the jobs creation front there. OK, let's ask you a bit more about this issue out of Greece. We had the credit rating agency Moody's come out to cut Greece down one notch, so the rating being A3. You've got the bond yields for Greece soaring, the euro hitting something like a one-year low against the US dollar. So what's your take on all of this? Look, the upshot is that Greece, their deficit as a percentage of GDP was estimated at 13.6%. Remember that membership of the EU stipulates that number shouldn't be any higher than 3, so they're way off the pitch there. The problem is that it seems that their forecasts were inaccurate, which is a very nice way of putting it, and that number might actually be revised up above 14%. It seriously calls into question, you know, the accuracy of their economic data. It further undermines the you know, the credibility of the EU rules, budget rules. You know, the market wasn't happy. We saw bond yields, as you mentioned, 10-year Greek bonds up over 9%. You know, that's nearly 3 times that of you know, a comparable bond from Germany, for example. The Aussie dollar euro, if we look at that, that's making new highs. It's just about 60 points off an all-time high there, which was back in 1997. You know, tongue-in-cheek, we could be talking about parity with the euro instead of the US dollar soon.
OK, well, we might talk about that, never know. Now, what about the EU and the IMF maybe looking to put some additional restrictions as we look at these kind of efforts to help Greece? Are we talking about some obligations here? What do you think?
Look, it's a really good question. I suppose only something we can speculate on at the moment. You know, if someone misbehaves and are unruly, they do need to get a smack. You know, the target for Greece was to have that deficit as a percentage of GDP down to 8.7 this year. That originally was only sort of a 4% move in the right direction, which was doable. You know, there's no point sort of setting goals and targets that are unrealistic. The problem is that the starting point keeps moving higher, so increasingly that seems less likely, and furthermore has a spillover effect to 2011, 2012, 2013, by which time I think they'd penciled in a 2% deficit as a percentage of GDP. It seems unlikely. Seems you know, a bit too aggressive. Backup measures, certainly, I think they've got to be there, but most importantly, I think they've got to get a little bit more scientific about you know, where we're measuring from, where the starting point is, and where the end point is, and you know, potentially stop moving the goalposts. OK, and so obviously, Simon, at the moment this does seem to be impacting our market today. We're down by 0.6%, as I mentioned. Is this an issue that the market's now going to struggle to ignore in some ways, or maybe we're losing a bit of patience, or is there something else happening? Yeah, it's pretty difficult to see it, I think, and as you mentioned, a mixed message. You know, the US held steady, it was all nice and good and happy there, but you flick to the Euro page and it's all red right away across the screen, which I think is probably a little bit unfair. You know, Greece is just a small part of a rather massive economy, which is Europe, and if you look at Europe as a whole, you look at their ratio of debt to GDP, you look at their deficit as a percentage of GDP, they're in much better shape than the US and Japan, for example. So, you know, you could speculate that potentially things are a little bit undervalued in Europe, and you know, are investors scratching their heads at the moment thinking, well, I'll you know, liquefy some of my Australian assets and buy in Europe because maybe they're a bit cheap at the moment. So that's quite interesting. Certainly on the currency front, it's going to affect it. You know, the Aussie dollar sitting at about 92.5 US cents. Traditionally a barometer for risk aversion. We've seen risk aversion jump up, but I've been pretty impressed by the Aussie dollar. I think it's held up pretty well. You know, you imagine last night everyone would have been dumping euros and buying US dollars. Would have expected to see the Aussie dollar a little bit lower, but I think today 11:30 we get trade data, which is important for our currency. You could argue that, you know, our historically strong terms of trade is what pulled this economy out of the recovery first of all, and you know, will underpin our growth for the next 2-3 years. So we'll be watching that data, and also today 1 p.m. we hear from Governor Glenn Stevens, who's going to talk about our economic conditions.
Simon Mariner, good stuff. Thank you very much.
Have a great day.
That's Simon Mariner there, just with the background on that Europe issue, and particularly the issue about Greece, which plagued those European equity markets overnight.